In the stock market, investors accept the risk that prices will fall from time to time, sometimes quite drastically. But people who buy houses may assume that their home's value won't ever go down much. They're not entirely wrong. The housing market historically has not been subject to frequent price bubbles and extreme volatility that characterize other investments. But there are times when the housing markets experience periods of irrational exuberance followed by reduced demand and prices. While buying or selling a home is much more complex than trading stocks or bonds, some of the same principles apply, including looking at long-term averages rather than short-term fluctuations. Hello and welcome back to the Finance Guardian channel. For today's video, we will talk about what you need to know about the housing market crash. So hit that subscribe button and the bell beside it and let's get started. What is a housing market crash? Usually a housing market follows a housing bubble, meaning that the average price of a home in a market is much higher than its value based on underlying fundamentals. This can be caused by excessive lending, not immediately recognized by the market. During the financial crash of 2007-2008, the price of homes in Western countries suffered a dramatic and persistent decline. The US saw a 7.1% drop in house prices in the fourth quarter of 2008, then another 7% decrease in the first quarter of 2010. These large declines were part of 19 consecutive quarters of negative house price growth. Unlike the US, the UK experienced a shorter and deeper contraction, where house prices fell by as much as 15% between 2008 and 2009. It was not until 2014 that the UK recovered from losses when average prices reached the same levels in 2007. An explanation for this has been attributed to the subprime mortgage crisis, during which several mortgage providers approved lenders who could not repay their debts. In turn, these mortgages were tied up in overvalued securities, ultimately destroying the global financial system and eroding home values. There is no doubt that a housing crash will cause pain to homeowners and real estate investors at first, but its consequences for the economy as a whole may be even more devastating. The Bank of England, or BOE, says that the value of a home constitutes a large portion of an average individual's asset value, giving them the confidence to spend in the economy. In a crash, the confidence is shattered, and some may find themselves in negative equity when the value of their home drops below the price they agreed to pay. This feeds into consumption patterns that can hurt equity prices and have macroeconomic policy implications as low demand spreads through the economy. Now that prices are rising faster than they did during the last bubble, some fear another painful correction is coming. However, analysts argue there are plenty of reasons to believe this time will be different. What is the impact of a recession on the housing market? It takes at least 2 consecutive quarters of negative GDP growth to declare a recession, typically accompanied by higher unemployment and lower consumer spending. A recession slows down the housing market as people suffer from financial strain. If they worry about layoffs, home buyers might pause their search, and there might be a slight increase in foreclosures. At the same time, higher unemployment increases the number of people unable to pay their mortgages. But when housing market activity slows down enough, mortgage interest rates drop so low that buyers come back to the market, looking to get a good deal. In contrast to the Great Recession, an increase in housing market activity helped bring the economy back to life. In the first 2 quarters of 2022, GDP dropped by 1.9% and 0.9% respectively, while GDP increased by 2.9% in the third quarter. There needs to be a larger economic slowdown than GDP to establish a real recession. A key indicator is unemployment, and according to the Bureau of Labor Statistics, unemployment remains low at 3.7% as of November 2022. Even though the tech sector is experiencing layoffs, the economy has not experienced as much of a slowdown as expected when interest rates are raised so quickly. Rather than falling apart, the real estate market will likely move sideways. The sideways movement of a market occurs when prices remain relatively stable without a significant trend upward or downward. Here are 5 compelling reasons pointed out by housing economists why the housing market isn't about to crash. Number 1. Inventories remain very low. The National Association of Realtors reported a 3.2-month supply of homes for sale in August. In February, that number dropped as low as mere 2-month supply. As a result of this ongoing lack of inventory, many buyers are still forced to bid up prices. Furthermore, it indicates that there will be no price crash soon due to the supply and demand equation. Number 2. There wasn't enough construction to meet demand. After the last crash, home builders pulled back significantly and did not fully ramp up to pre-2007. It is now impossible for them to buy land and obtain regulatory approvals quickly enough to satisfy demand. Although they are building to the best of their ability, they appear unlikely to repeat the overbuilding of 15 years ago. The lack of supply and heightened demand are primarily responsible for the run-up in prices. The supply and demand of homes can be restored to balance as buyers add more available homes to the market. More homeowners sell and prospective buyers get priced out of the market. However, it will not occur overnight. Number 3. New buyers are being created by demographic trends. The demand for homes is strong on many fronts. Many Americans who already owned homes decided to purchase larger houses during the pandemic, especially since more work is now being done from home. The millennial generation is huge and is in their prime buying years. Hispanics are also a young, growing demographic, enthusiastic about home ownership. Number 4. Lenders continue to impose strict lending standards. Liar loans, in which borrowers were not required to provide documentation of their income, were prevalent in 2007. Mortgages were available to almost anyone, regardless of their credit history or down payment size. Today, lenders have stricter credit requirements, and those who obtain a mortgage overwhelmingly have excellent credit ratings. Federal Reserve Bank of New York data indicates that mortgage borrowers' average credit scores in the third and fourth quarters of 2021 were 786, a record high. We are in a totally different situation if lending standards loosen and we return to the wild, wild west days of 2004-2006. The moment we start to see prices being driven up by the artificial buying power of lax lending standards, that's when we worry about a crash. Number 5. There has been a lull in foreclosure activity. In the aftermath of a housing crash, millions of foreclosures flooded the market, causing prices to plummet, but that isn't the case now. The majority of homeowners have a comfortable equity cushion in their homes. During the height of the pandemic, lenders did not file default notices, pushing foreclosures down to record lows by 2020. This suggests that home prices are outpacing affordability, but the boom should not end in a crash. What home buyers should do? The current housing market presents buyers with difficult choices. Predictions indicate that home prices will continue to rise and that new home construction will lag behind, resulting in tight housing situations for a long time. For some buyers, it may mean moving away from big cities into more affordable metropolises. Others may have to stretch their budget or compromise on size and other amenities. Then some buyers are willing to sacrifice important contingencies like the home inspection to sweeten their deal. If the seller fails to identify and fix major problems with the house upon inspection, it could cost them more in the long run. The upside of securing a house now, even if it means sacrificing other purchases, is that you could save money if home values and equity continue to rise. Also, you could save if you bought a house and locked in a rate before both home prices and interest rates rise. However, the opposite may also be true when limited supply and rising inflation can become so severe that they hurt the housing market and cause prices to fall, particularly if the economy enters a recession. Our failure to address housing supply shortages will fuel inflation rather than extinguish it. Resulting would be stagflation, a term most of us haven't used in a generation. High inflation and economic recession. This would destroy the housing industry and only exacerbate our current housing shortage. In the event of a sudden drop in home prices, buyers could end up with underwater mortgages, which means they must stay in the house until the market rebounds or sell and lose money. Although housing experts predict the scenario is unlikely, it should not be completely discounted. This is particularly relevant when buyers are faced with bidding wars or have to pay over the appraised value of a home. Although this tactic may be effective in some instances, one must be careful to consider whether the house, neighborhood, and time spent there will be worthwhile in the long run. When buying a home, it is important to consider how long you plan to stay there. People purchasing their forever home will not be affected by a market downturn because they can easily ride the wave of ups and downs. Buyers who intend to move within the next few years will be at greater risk if the market falls. For this reason, it's so important to find a realtor and lender you can trust to give sound advice at the outset. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.